Greetings, everybody. This is Jeff Scott. It is April 29th, 2018. It is 3:51 p.m. And I'm glad you're here to join me on what will probably be the last for quite some time of my top-down reviews. I titled today The Trendline Waltz Continues, and it is 3:51 p.m. Futures are not out. I've been doing these since before. I think I started doing them 2005 to 2007. I started. Originally did these every couple of months. I would do something to support HGSI online. And then I decided to do these weekly. I continued doing them because I wanted to continue to make sure people learn the messages of Ian Woodward. Ron and I spent a lot of time on the board, unpaid volunteers helping people. And it was just a way for me to give back some of the benefits that I got from knowing Ian. 2005 to 7 till now is a decade. I've gotten older, closer to retirement, done very well in the market, thanks to Ian and others. And I'm at a point now where doing this on a weekly basis is more of a commitment that I want to make. Just to give you an idea of that, I start with my scans at 4:15 on Friday. I finish my chart review after about 10 hours on Saturday, and then I have to do this program. So it's something that is overly consuming. And my wife said I needed a break, so I'm taking a break. But I do appreciate the fine comments I got. I can assure you this is not because it doesn't work, and it's not because I've lost an account or anything. I'm up over 40% this year on my trading account. I'll even show you that to prove it, so in case people have questions about it. And the stuff that I do, the stuff that I learned from Ian Woodward, some of just the basics, they work. As always, it's for educational purposes only. Any recommendations in the spirit of education, not investment advice. I'm a doctor, not a broker. I'm independent. I paid for the tools that I use, and trading involves at risk, and you alone are solely responsible for any decisions you make. Since this is the last time for a while, let me just call out and thank. I started with O'Neill like many of you did. I read How to Make Money in Stocks. I subscribed to investors.com. Somewhere along the line, I joined a product called Scan, which was one of the first online trading programs, going through a bulletin board, not even going through the internet, early days. While I was there, I met this guy, Ian Woodward. Ian Woodward was an expert speaker. He had some great ideas. I latched onto him. I spent a lot of time going to Ian's twice-a-year meetings, where I met another fellow student of Ian, Ron Brown. Over the years, Ron and Ian became very close, and until Ian's death 18 months ago, they formed Woodward and Brown Investing, and Ron remained, but together they were just a great dynamic of teachers. At one of Ian's meetings, he had this guy, Gil Morales, come and speak. So I got to know Gil. He's kind of a cynic and kind of a funny sense of humor, but boy, can that guy trade. And subsequently, I've read his books, and I've adopted some of the things that he does. Chris Katcher, his partner, is a dynamic, brilliant, true rocket scientist. How many people are you aware of that were involved in the identification of three elements in the periodic table? He's one. As I said, a true rocket scientist. Both of them were money managers for Bill O'Neill. Over here is John Person. Sometime around 2007, I spent about $2,000 and I bought, or $3,000, bought his indicator package for TradeStation. Subsequently, I bought it for Genesis, thinking I might do futures. John has become a very close friend of mine in the last couple of years. As it turns out, when I moved to Florida, I moved right around the corner from his office. John is someone who's helped me go from identifying great stocks and understanding the market to actually make money trading them. And there's a difference between being able to pick a list of stocks and knowing when to enter and exit, stop loss and money management. He's an author. He's a mentor. He teaches. He has indicators, and I appreciate what I've learned from John. Now, Van Tharp is the god of money management and position sizing. My chandelier stop that I talk about in my live education, something that I use, I learned from him. And then this here is George Lee, a super smart trader for, even though he is Canadian, kidding. Um, George and I have got to know each other first starting with watching him on Best Choice videos and then meeting him live at a Magenta Trader program. And subsequent to that, we've actually shared the stage and have done teaching together. I own a lot of programs. I actually didn't hide my desktop this time, but what I need if I got stranded on a desert isle that had internet access, that's sort of a joke. TradeStation and Thinkorswim, HGSI for my analytics, and EdgeRater. Seasonality trading, and you can pick your program, all of which have benefits. I do think is a nice supplement to technical analysis, and there are a number of trades throughout the year, like my January Netflix trade, a first quarter Priceline or now bookings trade as well. And then a number of websites. Genesis is probably not necessary for a stock trader, but it has a lot of things that I like in it. As I've always said, I'm independent of highgrowthstock.com. I, like Ron Brown, David Steckler, and many others, have provided free, uncompensated, volunteer help to people both through the board or at the request of Matt and George. I plan on continuing to do that. And I point out the free 30-day trial. Then under investing strategies, you'll see a large number of movies by myself, Ron Brown, and even Gil. One thing that I learned through my years of trading is that, oh my goodness, this is touchy, is that the stocks markets, stocks indexes are cyclical. That you want to be long in trending markets and you want to be short in trending markets to the downside. When you get to these periods of ambivalence and uncertainty, they will chop you up if you don't change your approach. We have been living in this uncertainty, oh my goodness, for quite some time. And I'm sure your portfolios were a lot easier to manage in January than over the last 6 weeks. Every time it looks like we're going to roll over, we take another leg up. Every time it looks like we're going to break out, we roll over. So we've sort of truncated the top of this curve and almost dancing in a Darvas box, although it's kind of an interesting pattern, which we'll talk about. So I changed my approach based upon where we are. Since I said we're in uncertainty, that means raise cash, smaller and less positions, and I've sold premium on many of my positions just to make some income. Friday was an interesting day. If I had gone to sleep at 9:30 and woke up at 5 o'clock and saw that my Amazon was up $50, I would have been super happy. The fact that it was up 100 plus earlier in the day is very typical. Intel, Microsoft, Amazon, almost everything that opened with big gaps came back into their patterns. Now, Amazon probably still had the best day of all. In regards to Amazon, I think everybody recognizes that it's a revenue machine, but it never makes much money. And that I've always felt that, and others have felt that all Bezos has to do is decide he wants to make money. He changes the switch, and now he produces money, not just revenue. And that's what happened this quarter, where he made over $3 a share when they were projecting $1.50. Plus, they had great revenue. So, what happened on Friday? Home builders were mixed to the strong. Materials were weak. Energy, after big run-ups, were weak. Financials were mixed. The regional banks were the strongest, as were the insurers. Going down the list, staples were stronger than technology. Discretionary, maybe not quite as strong as staples. Retail remained strong. Utilities were up across the board. Clearly, money was going into utilities. And the strange thing to me, with the interest rates going up over the last several weeks, why are we seeing bond equivalents start to move up? Do people think the rates are going to temper? Utilities were strong on Friday, as were REITs, which is somewhere in here. Property REITs were all up. So interesting end of the week. Going into Thinkorswim. Make these larger. Now I'm using a different resolution this time. I got tired of shrinking everything down just for these webinars. So if it doesn't come out clearly, don't worry, because I'm not doing another one for a while, but I think you'll be fine. Here is, to me, the challenge of the market. Drawing tools and a line. I'm not the greatest guy in drawing lines, but I don't think that's what I wanted to do, but let's start with drawing tools. I may just do this in HGSI. Regression line. It's a trend line. Oh, I guess I'm supposed to hit this and this. So you have a lower highs, but at the same time, higher lows. So what does that tell me? That the market is running up to the top, down to the bottom, may have one more day, and then it's going to reverse. And now we're going to get to the point where there's not going to be much movements. And then the question becomes, does this market, let's see if I find an arrow. Do we break to the upside? That's not coming, or we break out to the downside. I think this is a risky market that can go either way. But that's the pattern that we have. It is the same pattern, whether I look at the E-minis, the NASDAQs, the Dow, the Russell, all of them have lower highs and higher lows. Lower highs and higher lows. It can't continue forever because you'll get to a point where it's going to have to break above or below. The VIX this week came down some, and then the dollar ran right up to the falling 200-day moving average and gave a reversal. Now, will we have moderation of rates next week as indicated by what the utilities and REITs showed over the weekend? Will the dollar fall back, which will boost materials, commodities, etc., and oil? Or is the dollar going to regain its uptrend? I think the dollar is interesting here and something that I watch closely. If I go down into my weekly pictures, you'll see pretty much the same thing where you see the little triangle for me. We're living on the 50 weekly. It's holding on the NASDAQ. It's holding on the Dow. Oh, let's just put the IWM here because there's not enough on the other. Pretty much holding on the IWM. And yeah, I hate when Thinkorswim decided to no longer give me the DX or give me, is it $DXY? And give me the TFs. There you go. And you can see the dollar on a weekly doesn't look so bad, but it's got that falling 50 and a death cross on the dollar. So maybe the dollar's had its day. Put my VIX back here. So that's important to me as I start my plan of attack. I watch these throughout the day. And during the day, I actually will pull up this one where it's looking at 5-minute charts. And so it gives me a better sense of what's going on during the day. And I'll be watching, as I said, is the dollar coming back? Looks like it. That's interesting. That would be positive for oil and positive for gold. All right. So markets are in a trading range, and that trading range gets narrower and narrower. This is a high-risk market, but it doesn't mean it's going down. It could go up. If I want to look at in Genesis, I have a daily, a weekly, and a monthly row, and my columns are the E-minis, the NQs, the TFs, the NYSE, and the YM. And notice how longer-term charts are still trending, although we have sell signals on the monthly Dow and the monthly NYSE. And then we're choppy on the weekly and choppy on the daily. This is not a strong trending market that's easy to make money on. I like to look at what's going on in the market and underneath. So the 10-year looked like it continued to go up, but closing less than 3%, while there was a little mitigation and moderation on the 30. So if the yields stop going up, then that might be good for REITs, MLTs, utilities, dividend payers, and home builders. And I could tell you on Friday, REITs, utilities, dividend payers, and home builders, and some of the associated stocks showed some strength at the same time that so did regional banks. It's almost confusing. The AD lines, now the AD lines in white continue to go up, and they're being lagged by the indexes. And if I put the AD line here on the NYSE and I look at the IWM in very light blue, that is the Qs. In yellow, that's the spiders. Down here is the diamonds. They almost look like, despite the AD line going up, they gave back some on their amounts. So maybe there's a little positive divergence occurring there. And you can see, I apologize for this. I'm at an angle, so my mouse keeps thinking I'm doing something different. You can see bonds actually firmed up. This is a weekly chart. Breadth, I look at stocks above the 200-day, stocks above the 400-day. They're strong. They're not overbought. They're in the middle. This is the 3-month new high, new low ratio, T2121 on TC2000. And it's showing the number of new highs and new lows over the last 13 weeks. And it only matters at extremes. When we get down to the bottom, we have a move to the upside. When we get to the top, we reverse to the downside. We're in the upper half, but not at a single level. I look for multiple things on the Magellan. I look for divergences. I look for zero line rejects. I look for extremes. I don't see a whole lot of signals, but it's, again, you can see the lower highs and the higher lows on both the daily and on the weekly pattern. Something will give, but we don't know today which way that give is going to be. Now, the buckets, looking at the S&P 1500, the number of stocks above and below the midline of the Bollinger Bands, 60-40, favoring those above. And if we look at where they fall within their bands, clearly there's more in the upper part, and we now have over 10% above the bands. Not quite to a reversal area, but showing that we're getting a little bit overbought in the S&P 1500. Now, I think there was an error in one of my HGSI updates, or a number that was fixed later, because it looked like there was a Hindi in the middle of last week. But if I look down here on the NASDAQ and on the NYSE, there were no Hindis last week. Now, if you look closer, you'll notice that on one of these days, you have to both be above 2.2% to trigger a Hindi. And there were a couple of days that we were within a couple of stocks last week of triggering Hindis on the NASDAQ and within one stock of hitting it on the NYSE. I only updated the stock list on April 1st, so maybe we did have a Hindi. A Hindi occurs during times of turbulence. Typically, they occur at tops. We've already corrected, but that's just another sign of the turbulence and volatility in the market. A couple weeks ago, my market tone, the Woody indicator, which is this third column here, you can even see what they are at this resolution, was all green, and now we still have some green, and NASDAQ, the Russell, are still positive. Utilities are green, but there's no red, so we're bullish to neutral. And sector strength, again, looking down here, the red has resolved, but we still are plus minus with greens and yellows. Canaries in the coal mine, obviously, price line is now called bookings. It's reflected in the graph. Here is a graph of the canaries, I believe, and you can see that they broke back above the 50, which would have to be considered positive for the market. They held it despite the sell-off later in the day. Obviously, Amazon did not hurt that. I did a melt-up index in late January, and that is struggling to retake its 50-day moving average. The 17 has dropped below the 50. This just tells me that what led the market up in January are not necessarily doing well right now. So looking perhaps for new leadership. Earnings and news. I came up with this quote years ago, and the quote was, hello, it's a judgment call to hold stocks over earnings dates. It's bad judgment to not know when your stock's earning date is scheduled. Look at the earnings for this week. We have AK Steel, McDonald's, Transocean Rig, Aetna, Pfizer, Seagate, Shopify, Under Armour, Apple, Gilead, Snap, CVS, Humana, MasterCard, AIG, Apache, FireEye, Pioneer, Spotify, Tesla, Cardinal, Teva, Aristonet, EOG, Skyworks, Baba, and Celgene. This is a huge week of earnings for the S&P 500 stocks. And add to that on Tuesday, May 1st, we have a Fed meeting beginning, which will be announced at 2 p.m. So far, every time Powell speaks, the market falls. I don't see a planned press conference, but typically we start to see the talking heads. Here's Randall Quarles, William Dudley on Friday come out and talk a lot after this occurs. Lots of news this week, PMIs, FOMC, construction, and oh yeah, it's the first Friday of the month, so we have the monthly unemployment report. Market thoughts? Well, at least at the opening on Friday, FANG was back with exceptional EPS reports. It was disappointing to see these stocks fall off. Facebook, the F, obviously came out with blockbuster earnings as well. These early moves are negated as the day moves on. That is not bullish. Interest rates stable in the week. Are these a new norm, allowing interest rate sensitive stocks to show strength, or just a short-term aberration? Energy moderated, while strong EPS for Intel, Facebook, and Amazon unable to prop up technology. As I said, it's a huge week for the Fed, and we're range-bound with lower highs and higher lows. As we get to the apex, the market will break one day or another. So, being that I started these to pay homage to Ian, I thought I'd leave you, before I move on to the charts, with three of my favorite Ianisms. We grew up in the U.S. with chutes and ladders. Apparently, they weren't quite as pleasant in the U.K. where they had snakes and ladders. And Ian would love to talk about how when he would play his sister, snakes and ladders, and you hit the ladder, you get elevated, but that if you hit the head of the snake, especially on 62, you go all the way back to the beginning. And he used this analogy with, it's one thing to play a game with your money, but it's really not good to play snakes and ladders and lose the money that you save for your retirement. So I will say that in my early days, I spent a lot of time chasing the market up and down, and I didn't manage my money well based upon the market. And unfortunately, I had my days of playing chutes and ladders with my money. Not exactly fun. On the other hand, I learned enough to hopefully not do that anymore. So don't play snakes and ladders with your money. Second, Ianism. Why did I start this series of presentations off 10 years ago plus by calling it a top-down review? Why did Ian talk so much about top-down markets? The reason is that top-down is so important because of the importance of the market, not just your stock picking. In fact, 60% might be the market, 20, 30% might be the sector or industry group, and maybe 10% is your stock picking skills. So my guess is when you think you're making a lot of money and that you got really good at what you're doing, it's probably because you're buying stocks in a strong market in the right industry group. And even if you're good at what you do, If you're buying the wrong industry groups or against a strong market, you'll get hurt. This goes back 20 years. This was a monthly meeting that Ian had with a bunch of his followers in beautiful Palos Verdes Estates, California, where using the same techniques, the same analysis, they picked stocks every month. They kept track of the performance of those stocks, and then they assigned one of four different market descriptors: strong market, weak market, mixed strong, mixed weak. And then they looked at performance on a year and 3 months worth of data at 20 days and 40 days. Now, mind you, it's the same people, it's the same way of doing things. That in strong markets, they were up 106% in 20 days and down 32% in weak markets. Did they change? Was it them, or was it the impact of market on performance? So clearly it's the impact of market. Now, the other thing that's interesting and goes against the longer term holds that I might sometimes do is that most of the gains occurred in the first 20 days of the first month, and that even in a strong market, some of those gains mitigated over the next month. Certainly in a less strong market, those big gains evaporated over the next month. Now, in a mixed weak market, so I guess this is kind of a mixed weak market, some of the losses mitigated, but in a weak market, holding on to your losses did not win. In fact, they tripled in the next month. So top-down matters. The third one was the buckets, the 9-box matrix. We're looking at earnings per share growth on a current last 2 quarters rate and annual rate. You can build this out. And Ian showed after every bottom, when the market started to go up, if you bought stocks in the buckets, you outperformed. And I especially like boxes 1, 2, 5, and 7. And we've spent a lot of time over the years looking at that. So let's go through my usual top-down review, and then we'll say goodbye for a while. Now, I'm really not doing this to brag, but I had a lot of people say to me, "But Jeff, are you quitting because you blew up your account?" Because a lot of people seem to quit when that happens. I start every year with about $2.5 million in my trading account. Here is my P&L year to date, as you can see. If they didn't ding me $4,000 today for Amazon for reasons I have no idea, I would be at pretty much an even $1 million of profit. I play with margin. As you could see, my cash and sweep vehicle is negative. Now, some of it isn't buying stock with margin, it's selling naked puts, and they use up a lot of your margin against that. So the stuff that I've learned in HGSI has worked for me in strong markets and also in weak markets. But I trade different, and although this looks like a hell of a lot of positions, it's pretty much the least number of positions I've had in quite some time. And yeah, I've got a bunch of open profits, so I have a lot of option plays and different things on to protect them right now. So let's go into TradeStation and look at how I look at the markets, incorporating John Person's outstanding work. E-minis. So 5 or 6 things I look at. I'm in a downward arrow on daily, weekly, upwards on monthly. So long-term uptrend continues. Short-term, we're in downtrends. Boom. Number 2, color of the paint bar. Red is bearish. I should not be going long on a red candle. Green is bullish. I shouldn't be going short on a green candle. Blue is intermediate. The fact that I've got green candles here tells me there's strength in the E-minis, and perhaps we're getting close to a PPS buy signal coming in. So that's actually optimistic. Blue and blue on the weekly and monthly. Where do I sit within the envelope? Markets do not like to stay below or above for prolonged periods of time. We have no signal there. The fourth thing is I look for these red and green dots, red dots above, green dots would be low, and they show evidence of divergence when they're red dots or convergence when they're green dots. That might suggest a reversal. I look at the high jump. Once it's 95 or above, I know I've got a reversal coming. And I look at my weekly bongo, which is my typical buy-sell indicator, which is red. So I see a weak market here, but one that is showing some strength. So this is probably a weak market, but not a horribly bad market. If I look at the NASDAQ, not that that makes any sense to me either, you did have a buy come in this week. So you have a short-term and a long-term buy. Your weekly still in a sell. You got green bars. You're within the panels. You don't have the envelope. You don't have red or green dots. 39% still red. NASDAQ looks stronger, certainly driven by Amazon, Facebook, Netflix, and others. And I feel a little bit better about the NASDAQ. The Dow, blue bars, but in sell signals, kind of looks a lot like the S&P, a little bit weaker than the NASDAQ. And lastly, the Russell 2000, also in a sell signal. So what can I say about the markets? They're not strong. They're not horrible. The NASDAQ looks like it's leading. If I look at the 30-year bonds real quickly, I just wanted to point this out. If rates are going up, bonds should be going down. And isn't it interesting? Bonds are actually have a new buy signal this week. So maybe rates are mitigating. If I look at the dollar, and I think the dollar is pretty darn important right now, the dollar's been super strong, but what happened? We had a shooting star on Friday at the upper envelope. We have the red dots suggesting MACD divergence is in play. So, and we're at a 98% in the high jump bar. All my signals confirm that the dollar should be coming down, if not Monday or Tuesday by end of week. If the dollar comes down, who's going to benefit? Well, gold sort of been in a trading range, sort of the Darvis box. It's at the lower part of the range. It's got a blue bar. Gold looks like it might be ready to move. Silver has been weaker than gold and is still in a sell signal here with red. And then the VIX. I think I got the VIX in here. If not, I'm going to put the VIX in here. Hold on a second. Data, add blank row. At VX. I don't think that's what it is. Let's see. Yeah. VIX.X. All right. All right. Well, we're not going to do the VIX here. We'll look at an HGSI because I can't remember what the formula was. No biggie. Let me remove that. So I don't feel strong about the market going up, although the NASDAQ looks the strongest. Now for HGSI, I'm going to go down to top down, Major Markets Plus, hit my warehouse, make sure I've got my top down view on it, which is price and volume heavily weighted towards the last day of the trading. I got 23 things there. And what do I see? The strength is in the utilities, the NYSE, a lot of regional banks in there, transports, that's could be bullish for the market, bonds moving up. Hard to believe interest rates are going higher. And to the downside, volatility, semis, small caps, mid caps, S&P 100. All right. If I look at 5-day performance, utilities are up 2.5, gasoline and dollar were up 1.3. Biotech was actually up 0.6. The indexes were flat or down. If I look at 1-day performance here, I see that S&P was up 0.1%. Gold was up 0.5%. Transports, the leaders up 1.3%. If I open up the S&P 500, I can see and confirm that the Hindi that showed up earlier in the week with data corrections is no longer active. And as you can see on my homework, I've already put in the trend lines. So maybe you're smarter than me and you know which way we're going to break. I don't. What I do know is at some point, you're either going to break above and maybe go back and test old highs, or we're going to break below and go into a bear market. I'm betting we break to the high side. I'm not putting my money up on that bet. There's too much indecision here. But what I do know is how many more days do I think this market goes up before it reverses based upon the pattern we're in. Tough market to make money on either the long or the short side. And without a little bit more of the trending, I'm not so sure anything's going to change. So here's the S&P, which we've already talked about. The Dow, I could do the same thing when it comes to trend lines. Lower highs, higher lows. Not a whole lot else to say. Weekly bongos are negative in all of these. All right. We look at the Russell using the Russell ETF. We have lower highs, we have higher lows. And lastly, if I look at the NASDAQ, I see lower highs, higher lows. It is a tough market. It will break one way or the other. And I'm going to let the market tell me what it's going to do. I'm not going to tell you that I know what it's going to do in advance, because that would make me a liar. The dollar broke above the 200 and had a reversal candle. Notice the dollar's bongo has been green. I think this is important for the market. We'll see what it does. The VIX came down. Now, we're not quite to where we were living in 2017, but we've come off quite a bit. Does not look very bullish for the VIX, which is bullish for the market, therefore. And then gold and silver. The dollar's falling, then we might firm up here. As I said, we're in a trading range. We're at the lower half, and that silver below the 200-day moving average is clearly weaker than gold. So, mixed week market. Could go up, can go down. I wish I could tell you I knew everything. And then, like I said, that would make me not just a braggart, but a liar. So there's 173 groups. If I look at the 2-day force to the upside, I see 46. If I look to the downside, I see 25. So that's pressure to the upside. Now, if you're a high growth stock investor, you might be getting hurt, because what's to the downside, at least short term? Oil exploration, semi-devices, semi-manufacturing, steel, computers, refiners, which have been strong, infrastructure, software, internet, auto parts, application software. It was a very difficult day on Thursday and Friday for growth stocks. What's working now? So typically I'll look through the top 10 groups. We'll look through a couple very quickly. REITs, I mentioned that before. REITs looks great. Ventas is one that's on my buy watch. And I'll switch over to my warehouse view. And why did I like Ventas? Now, I call this a bottom fish. So here's a stock that's come down. It's not a triple bottom because it was still trending down. Had a couple pocket pivots, a kahuna, mobile breakout from a squeeze, weekly bongo turned green. Great earnings per share growth, pays a 6% dividend. So that means it pays about $3 per year, and it's taking in about, if it maintains these earnings over the next $3 to $4 per share. So it has money to pay its dividend. It's sold off hard. I look to see what it's in. And senior housing, medical office building, life science, innovation. I don't see retail. That makes me happy. I think they bought an asset recently that was in my space as well. This looks very interesting to me. And like I said, Ventas is on my buy list. The downside, tons of overhead supply. Okay, anybody that's bought this stock in the last year has lost money, and therefore they might be looking to sell. It is deep in its pattern. I could put a buy stop probably around 52 and probably put my sell stop underneath the 50, because when it goes down below the 50, I'm going to be out. I'd rather buy stocks that are in the upper right-hand corner in the winner circle, but this looks interesting as long as you understand it's not a big growth winner right now. Simon Properties, I'm going to pass on this one. Great earnings per share growth, great dividend. More into shopping centers, I worry about them. Welltower, there's a series of healthcare REITs. Make sure this is what I think it is. Senior housing, medical facilities that look like they bottomed. This is one of them. I'll show you some more later. Kahuna, I like the first one better. Digital Realty Trust is one of the places that is the colas where they keep the data servers. Great earnings per share growth, 3.7% dividend. Again, lots of overhead supply, as taught to us by Ian. And then public storage, it's got to have get through the 200 to make me interesting. Some of the ones that stood out to me, HCP is one of the physician ones, and it's been down, and now it's got a higher low than it had back here. Multiple pocket pivots, Kahuna, mobile breakout from a squeeze, a weekly bond goes green, pays 6%, and has enough earnings, I think, to support it. So there are some REITs that look interesting. I may show you a couple of different ones later. Oil and gas services. Here's Arch Rock. Interesting chart, if I remember correctly. So it's still at a downtrend. It did break above the 200. It had a pocket pivot. Look at the earnings, the volume that came into the stock on Friday. 19 million shares. The average volume is 1.9. That becomes an interesting question. So I might go to more info from the web, which apparently you just hit Alt G. But here's FinViz. And did I learn anything about this company? This sounds like they're doing well at their business. Earnings out. Oh, nope, merger off my books. All right, continuing down this list, Halliburton has worked its way back up above its moving averages. The 17 has crossed above the 50. I'm long Halliburton. My target might be this high at 58. It had a mobile breakout. It's probably a little late for most people to start buying. Oil States is working out nicely. Patterson. So Halliburton looks my favorite. The first one looks like it's a takeover. Containers and package index. That means to me that the economy must be working. Because during a period of recession, these things get clobbered. Now, the first thing I noticed is that they're all below the index. That's interesting. Let me just do a scaled version. They're all still below the index. I usually don't get excited by groups that are below the index, but let's just look at a couple. Berry Global Group. This used to be, I think, Berry Plastics. It's in a short-term downtrend. Looks like it's stabilizing. Not ready for me. Crown Cork and Seal, not interested. Ball Corp, not interested. Sealed Air, not interested. Silgan Holdings. So here's one of the problems. It's, if you have sector rotation in a market that's chopping, everything chops. The things that come to the top on sector rotation are chopping at the high end of their trading range, and things that are at the bottom are probably at the low end of their trading range. The problem is they're chopped, and that's what we saw there. Biotech. So Alexion had some standout earnings, and we'll see if it can cause this group to wake up. But it still has to get above the 200-day moving average. It's priced fairly. It's always been a high-cost biotech. Their pipeline is improving. Kind of a sideways-looking chart. It's not a trending chart. I'm going to pass. Biogen. All right, so here's what I'm looking. If I was buying it, which I'm not saying, I'm going to be buying it because it's bottom fishing. And if I look back, I can see it's about the same place it got to in the lows of 2017. Maybe it's worth taking a runner there. Probably not me. Amgen. This is one that has a good pipeline as well. Sideways. CGen, sideways. Hard to get excited by any of these, folks. This is one that I think will be the next Kiter Juno and get bought out, probably by Celgene. The problem with Bluebird Bio, it's an expensive stock already. Its market cap's $8 billion. That's not too much to be bought out, but it's probably priced in the buyout already, since it has no products on the market. So biotech may look okay from a force perspective, but I don't see anything to buy. Specialty pharma. I don't like the first one. Acorn was being bought by Fresenius, and they dumped them because of some data discrepancies, and the next thing you know, they said maybe it's not over, and they popped. I would be passing this one. Ironwood Pharma, don't know much about this. but it looks like it's breaking out here. Flag, pull back and a breakout from the flag. This is one that I think is on my buy watch list. Endo, bottom fish, had a bunch of kahunas, vocal breakup from a squeeze. That's interesting. But boy, has this got overhead supply. I'm not going after this puppy. Is Valiant ready to recover? Probably not yet. Nothing's coming out here and saying, I must be bought. E-commerce discretionary. I love Amazon. I guess one thing I've also learned over the last couple of years, we used to say that penny stocks are cheap for a reason. That reason being that they're not worth anything. I think the corollary goes for big, expensive stocks. My portfolio performance has really improved since I started buying expensive stocks and not limiting myself to the $10, $20, $30 stocks. This is a great animal. I was listening to Dan Fitzpatrick earlier, who says it's going to go to 2,000 by year's end. I totally agree. He also thinks it may pull back. This is not a good finish to a great earnings day. I'm long, super long Amazon. I've got some calls that I sold against some. I bought a bunch of call spreads when I bought them in the 1400s when they pulled back, and they're 1600 as takeout. So we'll see if they get called away or not. But it's been a big move. I'm still bullish on Amazon, but maybe it's got some backfilling to do. Alibaba, sitting on its 200. I think the China stocks have been weak, maybe concerned about tariffs. Might be a good time to buy, but not yet for me. I like to see some momentum. VIPs, no. Chegg, I don't know this stock, and I don't like its low earnings. But you got a stock that off the 50 had a pocket pivot, a belt hold, and with a bullish engulfing pattern. I like the chart pattern. I don't think the stock's beefy enough for the company for me to go into it. JD.com, no. Mercado Libre, the South American eBay, maybe setting up. So you see, there's not a lot of great stocks. You'll find some here, I'm sure. Here is Apparel Footwear. Nike. Run up, sideways base, breakout on Friday. Global breakout from a squeeze. Pocket pivots, kahunas. Nike looks like it wants to go higher. Under Armour, similar pattern from the bottom of the chart versus Nike, which is up in the upper right-hand corner. Is it worth a flyer on Under Armour here? I don't see the earnings to support it, but maybe. I could see nibbling on that, and I think it made it to my watch list. Haynes Brothers, no. VF Corp, uptrend, sort of a cup, handle, breakout. VF Corp looks interesting. Michael Kors, uptrend, shallow cup, handle, breakout. That looks interesting. A lot of these stocks look good. Ralph Lauren has been a big winner of late, now going sideways. So thus far, I'd say I've seen some things that look interesting on the REITs and on the apparel footwear. Consumer finance showed some movement. Visa and MasterCard, make sure you know when earnings are. Visa's earnings, I think, are out. Beautiful uptrend, and it's getting kind of loose up here. Maybe it's ready to start again. I'm watching Visa. MasterCard has earnings this week. Here's a Nova. Nothing there. Nothing there. I'm looking for things that look like I want to buy them. I don't see a lot there, except for maybe the Visa was probably the best of the bunch from my perspective. Number 9 was restaurants. I don't usually buy them, but I have been playing Chipotle Mexican Grill. This is another one that had a great earnings day. Closed at the top near the top of their trading, but there's a lot of spread on this day. Let's look at it for exactly. The open was 420, the high was 433, the low 416. So it's not as much off of its high as Amazon was. But what a beautiful day for Chipotle. This is a combination of a new CEO, new belief by the investment community, And hopefully they can keep the E. coli away. So CMG, BJ's leader. The restaurants look very strong. It's not a place that I usually, this growth guy actually doesn't like to go there. And then large pharma. AbbVie has been one of my favorites. They stubbed their toe on a cancer drug, which is, I think, overdone. Great earnings per share growth, multiples of their PE, a 3.9% dividend. I like buying this when it's cheap. I think the stock goes much higher. And here you go. You're buying a great stock at a discount. AbbVie, buy list. J&J downtrend, Eli Lilly, Bristol Myers Squibb. Bristol Myers Squibb has come down. They've relied so much on Opdivo and their immuno-oncology franchise, and Merck just kicked their ass. Pfizer actually owns some of this as a 3.7% dividend. It's already had a nice little run. So where's Merck? Here's Merck and Company. It doesn't look very good itself, but pull back here to the 50. If it moves, or 200 rather, if it bounces off this, it might be interesting. They are setting the world on fire with Keytruda, which is their lung cancer drug. They really came out with data in the last couple of weeks that I think changes the paradigm of the standard of care. Now, look at other groups that are up here, airlines. Here's your utilities, your telecoms. I like to buy Verizon when it's cheap. Maybe it's not so cheap. It's up 7% last week. But, you've got a stock that's pulled back, broke out, multiple kahunas and pocket pivots, bond goes green. Earnings per share growth, which is twice what the PE is, pays a 4.6% dividend. I'll make more money holding Verizon and buying it at the lower part of its channel than I will putting it in the bank. I think Verizon looks good. So I've done my top-down review. I'll spend a couple of seconds talking about some other things that I do. There is a young kid, T.G. Watkins, that has come up with something called the Moxie Trader. And I've been spending a lot of time playing with it. And I found a tool. Let me say that differently. He has found a tool that allows us to find stocks that are moving early. And I look at typically an hourly chart, an hourly scan, and look at some of the stocks that are here. And I'm just doing this on the fly, by the way. Urban Outfitters, I talked about buying it, and I did when I was out a couple weeks ago in Orange County. Here's that Innova Specialty Finance stock, DSW, ASNA. So let's just look at Teladoc, Urban. Let's look at URBN. Oh, I'm going to pause this for a second and fix